Afternoon, everyone, and thank you, Steve and team, for having us here today. This is my first time in Emergence, but it is quite the production. My name's Edward Carroll. I'm here representing a firm called MHC Digital Group. We're an investment bank for all things digital assets. I'm here to chat to you today about an investment theme which we believe is one of the most important asset allocation considerations of our time. That is, the investment into digital assets. What do I mean by that? Well, crypto. So a slight pivot from your previous property discussions. If you didn't believe it before 2025, it's clear now. What was once a fringe movement is now an unstoppable force. For years, digital assets have been the black sheep of traditional finance, dismissed and derided by Wall Street as a speculative fad or at worst a scam. Over the years, governments have done their best to stifle adoption, banks have prevented participation, but it seems the market has spoken. I've added some of my favourite quotes here from both sides of the aisle, but you'll see that some fairly meaningful traditional investors don't seem to like the sector, but then we've got a bit more interest on the right here. But I think what's clear to us is that the sentiment has really shifted, particularly the last 12, 18 months, and I'd like to talk to you about why and what that means to your portfolios. Let's start with what are digital assets. When I joined the sector 3 to 4 years ago, it wasn't really clear to me exactly what people meant when they said digital assets or crypto. Often people associate it with either Bitcoin or some sort of a scam meme coin or somewhere in between. The way we think about digital assets in general is that digital assets are basically anything that sits on the blockchain or uses blockchain technology. At MHC, we carved that out into sort of 3 buckets to give a little bit more clarity over exactly what that means. And I think it's important to understand that for consideration for investment allocation and for understanding the risks attached to each bucket and necessarily how you should look to allocate to them. The first is blockchain as a technology solution. Here we go. Blockchain technology can optimize a whole bunch of traditional financial products and services. This is typically referred to as tokenization. The sort of usual association with that is for fractionalizing real estate, fractionalizing bank bonds, basically representing anything real world on the blockchain. And I think this has been the focus of a lot of the regulators globally because it's largely captured by existing financial markets regulation. So it's just implementing an alternative technology solution to provide products and services which are already have an existing regulatory framework to support them. The second is blockchain as a payment alternative, and what we mean by that is stablecoins. We carve that out. Stablecoins are effectively the most obvious real-world asset representation using blockchain technology. If anyone doesn't know what a stablecoin is, in effect, it's a blockchain-based token representing a fiat balance sitting in a bank account. There are variations to that, but that's kind of the crux of what they are. We think that there's an enormous opportunity for this technology and this product to disrupt traditional payment services. We think that an on-chain FX market is the future of cross-border payments and FX hedging. We actually have announced a partnership the last couple of months with a company called Circle, who are the largest regulated stablecoin provider in the world. And the third bucket is the more sort of esoteric tokens which have been built on a blockchain, often creating ecosystems of value which previously didn't exist. The most obvious example of that is Bitcoin, but it also includes the sort of large cap opportunities in Bitcoin, Ethereum, a couple of the other larger cap ones, altcoins, and then you sort of go all the way through to meme coins, NFTs. But we think of that bucket as kind of like, that's the least understood, certainly from a regulatory standpoint, but also we think that there's probably the most opportunity there for allocation if you have the right manager and the right person advising you and managing the allocation for you. So for the sake of this discussion, we'll be largely focused on bucket number 3 with a real focus on Bitcoin because that's really the proxy for what we think is probably the logical starting point for anyone looking to allocate to the sector. Let's just move to the changing institutional attitudes towards digital assets. 2024 was a monumental year for the sector. We had the announcement of the first ETFs for Bitcoin. There's been subsequent announcements relating to Ethereum and Solana. But what that's meant is it basically gave a well-known and understood product for institutions to allocate to the sector. So we saw net inflows of $64 billion in 2024, which was huge. I think more key to that is that 94% of institutions in a recent EY study have indicated that they believe in the long-term value of digital assets, broadly defined. But as part of that, only 67% of them had looked to allocate at all, and almost all of them felt significantly underallocated. And we'll talk about what that means for the future of price action, demand, and how that should necessarily impact your views on allocating to the sector. But a couple of the more prominent institutions who've allocated, BlackRock, Fidelity, VanEck, JP Morgan, some of them were very critical to start with the sector and then have subsequently changed tune to provide access because the wave of demand from their clients has been too strong to deny that there's an opportunity to allocate here. Let's move to the investment case for digital assets. I want to focus here on really what the changing dynamic has been and what that's really driven by and why you should consider it for your allocation. And really what it comes down to is that regulatory clarity, it's catalyzed an enormous paradigm shift which has drastically reprofiled the sector from a risk standpoint for consideration for allocation. And what that's meant is it's then opened up enormous opportunity and it's basically given a green light to institutions to allocate. It's also given a lot more comfort for retail investors. And I guess in general, it really has just created a green light for a flood of additional capital and interest in the sector. If we just talk about, as a general statement, the effect of this regulation and what I'm sort of terming the flywheel effect here, the additional allocation that comes from the green light from regulators, what it does is it spurs allocation to the sector, which then actually improves liquidity, which subsequently lowers volatility, which then in turn increases attractiveness of the sector by way of additional products being, a deepening product pool being provided to the sector. What we've seen is that there's been significant investment from banks and institutionally backed investment firms looking to build infrastructure for the sector. The quality of the product is improving, and it's basically overall massively improved the attractiveness of the sector for institutions. And I'll just add that the regulation is not specific to Trump being elected. It's also, we're seeing, I'm based in Singapore, we're seeing the MAS very, very aggressively going after building a framework. We have the EU's got a very strong framework coming out. The Middle East has multiple frameworks coming, all of which are very supportive. But the direction and the flow of the tide is very firmly in favour of adoption. And that's what's created this enormous opportunity. I think as a specific case in point, though, and the effect of this on pricing, we're now very, very bullish about Bitcoin as a result of this. We think that firstly, the opening up of ETFs, but then subsequently the kind of green light from the regulators around the world to allocate to Bitcoin, that's catalyzed this enormous shift in the demand-supply dynamic specifically of that asset. Anyone that understands Bitcoin knows that it has a fixed supply curve, and what we think has happened on the demand side with this kind of green light to allocate more to the sector, what that has meant is that the demand curve, the demand is massively overwhelming supply. And we think that that theme will continue for a while. I get asked all the time what my view is on where we think Bitcoin's going. I recently said that I think that despite price action in the last 48 hours, that we probably will see $160,000 US per Bitcoin by the end of the year, and we're expecting to see $1 million within 5 years. And there are some significant, and that thesis is supported by a number of bank analysts we've seen recently, and it's consistent with a lot of the more institutional types who've come into the sector recently. Just to touch now on the role of digital assets in a portfolio, very quickly, I've put some numbers on 10-year Bitcoin correlation with other asset classes just to show how much it does provide diversification benefits for investors. And I'll also add that I did just a quick numbers to show the effect of a historical portfolio allocation to Bitcoin within a traditional portfolio. So you'll see here, if you had allocated 5% of a $1 million portfolio 10 years ago into Bitcoin, and you dollar cost average that 50,000 allocation monthly over a 10-year period, the effect of the Bitcoin allocation would more than double your returns. So Bitcoin has historically played a huge role in portfolios. BlackRock suggested 1 to 2% allocation. We think that's probably a good starting point for anyone looking to come in. But there is really, in our view, an enormous opportunity to allocate to Bitcoin, and there's subsequently going to be significantly other opportunities for other digital assets as well in your portfolio. Let's move to us. So who are we at MHC? We are the investment bank for all of your digital asset needs. Our global markets platform provides wholesale investors in Australia with the safest place to buy and hold all forms of digital assets acquired through a state-of-the-art proprietary customer interface, providing institutional-grade pricing and custody. We'll soon be rolling out a suite of additional derivative products to allow our investors the best venue to both explore and monetize their holdings. In addition, we have a funds platform combining both venture and liquid strategies. This provides access to our industry-leading investment team and can give you a trusted manager for any kind of broad-based allocation to the sector. And our PM, I believe, is in the room, Andy Palmer over there, so please reach out to him if you want to speak about that. I think core to our kind of mission and our team is our founder, Mark Carnegie. He has a background in financial services. He built an investment bank, sold that, and we've got an adjacent alternative asset management platform. We're very focused on trust. We've built a team of very experienced people to be a trusted partner for your allocation to the digital asset sector. And so if you'd like to have a chat with any of us, please reach out. We've got a booth just out there. We'd love to have a chat. But I would strongly recommend considering allocation of digital assets in your portfolio because we think over the right time horizon, the only way is up. So thank you very much.